Hi everybody. In this video we'll take a closer look at defined benefit pension plans. Unlike defined contribution pension plans, defined benefit pension plans promise fixed retirement benefits defined by a designated formula. A typical formula might specify that a retiree will receive annual retirement benefits based on the employee's years of service and annual pay at retirement, or perhaps the annual pay for the last several years before retirement, or perhaps the highest annual pay achieved. For example, a pension formula might define annual retirement benefits as 1.5% times years of service times final year's salary. By this formula, the annual benefits to an employee who retires after 30 years of service with a final salary of $100,000 would be 1.5% times 30 years times $100,000 equals $45,000 per year of retirement benefits. When setting aside cash to fund a pension plan, the uncertainty surrounding the rate of return on plan assets is but one of several uncertainties inherent in a defined benefit plan. Employee turnover affects the number of employees who ultimately will become eligible for retirement benefits. The age at which employees will choose to retire, as well as life expectancies, will impact both the length of the retirement period and the amount of benefits. Inflation, future compensation levels, and interest rates also have obvious influences on eventual benefits. Typically, a firm will hire an actuary, a professional trained in a particular branch of statistics and mathematics, to assess the various uncertainties, employee turnover, salary levels, mortality, etc., and to estimate the company's obligation to employees in connection with its pension plan. Such estimates are inherently subjective, so regardless of the skill of the actuary, estimates invariably deviate from the actual outcome to one degree or another. Here's an easy concept check problem for you. Which of the following describes defined benefit pension plans? A. The investment risk is borne by the employee. B. The plans are simple and easy to construct. C. The investment risk is borne by the employer. Or D. Retirement benefits depend on the individual's account balance. The correct answer is C. The employer bears the investment risk under a defined benefit pension plan. Pension gains or losses can develop when the pension obligation is higher or lower than expected, and when the return on plan assets is higher or lower than expected. Later, we'll discuss accounting treatments of gains and losses derived from changes in an estimate. The point here is that the risk of the pension obligation changing unexpectedly, or the pension funds being inadequate to meet the obligation, is borne by the employer with a defined benefit pension plan. The key elements of a defined benefit pension plan are: 1. The employer's obligation to pay retirement benefits in the future. 2. The plan assets set aside by the employer from which the retirement benefits will be paid in the future. And 3. the periodic expense of having a pension plan. As you will learn in this chapter, the first two elements are not reported individually in the employer's financial statement. It is critical to understand the composition of both the pension obligation and the plan assets, because A, they are reported as a net amount in the balance sheet, and B, their balances are reported in disclosure notes. And importantly, the pension expense reported in the income statement is a direct composite of periodic changes that occur in both the pension obligation and the plan assets. Illustration 17-3 in your textbook provides an overview of the components of pension expense. This is an important summary. I would suggest that you flag this page. The annual pension expense reflects changes in both the pension obligation and the plan assets. This illustration provides a brief overview of how these changes are included in pension expense. So the components of pension expense overview is service cost ascribed to employee service during the current period, plus interest accrued on the pension liability, minus the expected return on plan assets, plus the amortized portion of the prior service costs attributed to employee service before an amendment to the pension plan, and plus or minus losses or gains from revisions in the pension liability or from investing plan assets. All of that will equal pension expense. And I've not spelled expected correctly. Let me change that for you. There, that's better. Looking at this, it's important to note that interest and investment returns are financing aspects of the pension cost. Recognition of some elements of the pension expense is delayed. Notice it says amortization of. And the annual pension expense reflects changes in both the pension obligation and the plan assets. We'll cover all of the aspects in this calculation as we continue working through this chapter. Now let's consider more precisely what is meant by the pension obligation. Unfortunately, there is not just one definition, nor is there uniformity concerning which definition is most appropriate for pension accounting. Actually, there are 3 different ways to measure the pension obligation, as shown in this example, or this illustration. The accumulated benefit obligation, ABO, is the actuary's estimate of the total retirement benefits earned so far by employees at their discounted present value, calculated by applying the pension formula using existing compensation levels. So the ABO applies the formula using existing compensation levels. And of course, all of these are discounted to the present value. Number 2, vested benefit obligation, VBO, is the portion of accumulated benefit obligation that plan participants are entitled to receive regardless of their continued employment. We'll talk more about vesting in a little while. Number 3, the projected benefit obligation, PBO, is the actuary's estimate of the total retirement benefits earned so far by employees at their discounted present value, calculated by applying the pension formula using estimated future compensation levels. If the pension formula does not include future compensation levels, the PBO and ABO are the same. Later, you will learn that the projected benefit obligation is the basis for some elements of the periodic pension expense. Remember, there is but one obligation. These are simply three different ways to measure it. The relationship among the three is depicted in this illustration. The PBO includes everything. The present value of the non-vested ABO. The ABO includes the non-vested and vested, and the present value of the vested benefits just includes the present value of vested benefits. The accumulated benefit obligation, ABO, is an estimate of the discounted present value of retirement benefits earned so far by employees applying the plan's pension formula using existing compensation levels. When we look at a detailed calculation of the projected benefit obligation later, keep in mind that simply using the employee's existing compensation in the pension formula instead of the projected salary at retirement would give us the ABO, accumulated benefit obligation. So really the only difference in the calculation between the ABO and the PBO is the ABO uses existing compensation and the PBO uses future compensation. Now let's talk just a little bit about vesting. Suppose an employee leaves the company to take another job. Will they get earned benefits at retirement? The answer depends on whether the benefits are vested under the terms of the particular pension plan. If benefits are fully vested, yes. Vested benefits are those that the employees have the right to receive even if their employment were to cease today. Pension plans typically require some minimum period of employment before benefits vest. Today, benefits must vest under a couple of different alternatives. The first being they must vest fully within 5 years. Or they could vest 20% within 3 years, with another 20% vesting each subsequent year until fully vested after 7 years. The 5-year vesting is most common. Since it is unlikely that there will be no salary increases between now and retirement, a more meaningful measurement should include a projection of what the salary might be at retirement. Measured this way, the liability is referred to as the projected benefit obligation, or PBO. The PBO estimates retirement benefits by applying the pension formula using projected future compensation levels. Hereafter, in this chapter, when we mention pension obligation, we are referring to the PBO. The PBO measurement may be less reliable than the ABO, but it is more relevant and more faithful to the concept behind these calculations. Let's work another easy concept check problem. The projected benefit obligation is best described as the A, present value of benefits accrued to date based on future salary levels. B, present value of benefits accrued to date based on current salary levels. C, increase in retroactive benefits at the date of the amendment of a plan. Or D, amount of the adjustment necessary to reflect the difference between actual and estimated actuarial returns. And the correct answer is A. The projected benefit obligation, PBO, represents the present value of benefits earned by employees to date based on estimated future salary levels. Well, that's all for this video. In the next video, we'll work more closely with the projected benefit obligation.